Imagine you just finished a grueling shift flipping burgers. You've traded your physical energy and your limited time directly for a paycheck. You get an email saying you were paid $2,000, but your bank balance only reflects $1,400. Federal tax, state tax, Social Security, Medicare, these are the invisible costs of civilization, siphoned away before you ever touch the money. You likely assume the remaining cash is sitting safely in a bank vault, guarded and waiting for you to come back and claim it. In reality, your money is already gone. Through a system called fractional reserve banking, the bank only keeps about 10. This exposes the ultimate illusion. Currency has no intrinsic physical value. A dollar bill only carries power because we, as a society, have collectively agreed to believe it does. Finance is a game played with these imaginary constructs. Because the system is built on constant circulation and credit, the money you leave sitting still is money that isn't participating in the engine of growth. Even when your money is sitting in your pocket, it is losing value through inflation. Your $5 bill still says $5, but over time, it buys less gas, less food, and less of your time back. Look at this ratio. If 2,000 people have the cash to buy a TV, but only 1,000 TVs are available, the price jumps from $500 to $800. This is inflation. Too much money chasing too few goods. When the economy overheats, it triggers a recession, a painful reset where spending stops, companies downsize, and jobs vanish as the market tries to find its footing again. The government fights this by raising interest rates. By making borrowing more expensive, they intentionally reduce the amount of money people can spend, cooling off the economy to bring prices back under control. These booms and busts aren't random disasters. They are the predictable, systemic breathing of the modern financial markets. When you need to borrow money during these cycles, you pay interest. Interest is simply the rent you pay to use someone else's cash for a time. Missing a payment triggers compound interest. Now you aren't just paying back the original $12, you're paying interest on that interest. Very quickly, a small purchase can spiral into a massive financial fire. Lenders decide who gets to play this game by looking at your credit score, a 3-digit algorithm that predicts how likely you are to pay them back. This score is calculated using variables like your payment history and your credit utilization. It tracks your past behavior to determine your future reliability. It's important to note that a high score isn't a sign of wealth. It's a sign of looking good to a lender. You can have a high net worth and a trash score if you've never participated in their credit system. To navigate this, you must recognize that interest is used to extract your wealth, while scores are used to mitigate the lender's risk. Generating significant wealth requires understanding that value is often an illusion. These gold bars are just heavy yellow rocks. They aren't worth more than any other stone. They are expensive because humans have collectively placed a high value on them. True wealth is built by creating this perception. When Steve Jobs introduced the iPhone, he provided a tool that millions of people perceived as indispensable, leading them to pay thousands for a device they didn't know they needed. Luxury brands like Gucci operate on the same logic. They can sell a handbag for 100 times the price of a generic version because the market perceives the brand itself as more valuable, regardless of the materials used. Trading hours for wages has a hard mathematical ceiling, the number of hours in a day. But by scaling perceived value to millions of people at once, through products or branding, you decouple your income from your time. Since inflation is constantly eroding the value of your cash, hoarding money is a losing strategy. The only way to protect your future is to move that money into assets. Investing is the process of putting your money to work so that it generates more money, effectively replacing your physical labor with capital. This is typically done through stocks, which represent company ownership, bonds, which are loans to governments, or real estate and diversified funds. While these vehicles are important, the most critical variable in the entire equation is time. When compound interest is applied to consistent investments over decades, the growth is exponential. This is how ordinary paychecks transform into 7-figure wealth, not through luck, but through the patient multiplication of assets. The financial system is not a static vault, it's a moving current. You can let inflation drag you under, or you can learn the rules, deploy your assets, and let time build your wealth.